Hi friends, welcome back to the channel. I have been sharing my portfolio allocations for almost a year now. If you ask me to describe my strategy, actually I will have a hard time to describe them until I learned about this strategy called coffee can portfolio. This is because I noticed that my approach is pretty similar to a coffee can portfolio. So in this video, I will share with you what is coffee can portfolio and you can consider to adopt this strategy as well. What is coffee can portfolio? The approach is similar to how our grandparents used to keep money in biscuit or Milo tins. In the case of stock investing, instead of keeping cash in the Milo tins, you are constructing a portfolio of high quality stocks for the long run and simply let them sit. So every time you have a saving, you just buy the shares of quality companies. Once you bought, you basically never touch it. Of course, not only one stock, you can still have a diversified portfolio consists of 10 to 30 stocks. The number doesn't really matter. The biggest benefit of the coffee can portfolio is that it keeps your worst instinct and emotions from hurting your investments. One of the worst enemy of your portfolio is actually yourself. We tend to do stupid stuff when we are panicked and not thinking straight. For example, selling the shares of good companies when the share price drops significantly. So if you are using coffee can portfolio strategy, there is no FOMO, no anxiety over volatile stocks, no timing of the market. Basically, you just consistently buy the shares of quality companies. Put those shares into your coffee can or Milo tin, whatever you call it. You don't have to consistently buy one stocks and move to another stocks just because a random YouTuber say this stock is going to 10x soon. Next, I would like to explain why this approach is superior to many other strategies. First, we need to admit that we are all human, we have emotion. In stock market, the stock prices are constantly going up and down. It is basically a probability game if you look at it from a short-term perspective, a bit like gambling in casino. With this type of setup, our human tendency is to look for quick win to make ourselves feel good. One common way to seek this kind of quick win is to buy on reversal. You look for beaten down stock and because they look cheap now, so you buy with the hope that they will reverse. I think this may work over a short period of time, hence they are applicable for trading strategies. What about stock investing over the long term? In my opinion, this bet on reversal won't work as great over the long term. This is because if a company is successful, their share price goes up, financing costs become cheaper, and they are able to attract the best talent. Management get the trust from the shareholders and they can afford to work on long-short projects like how Amazon inventing AWS.
A number of our customers said, well, this is great if I have hundreds of petabytes or dozens of petabytes. What about if I have exabytes of data? And we have a lot of customers who have exabytes of data. And the first thing that came to mind was, we're going to need a bigger box. Introducing AWS SnowMobile.
Success breeds more successes. This is why you see that companies that achieve some successes have better chance to be even more successful in the future. On the other hand, companies that are lag over competitors will tend to focus on short term, such as using share buyback to boost share price, which doesn't solve any of their long-term problem. The outcome is that stock prices tend to be trending over the long term. Some good companies, their share price goes up and up and up. Those that trending down will tend to continue to do so as well. How can we use this information for the benefit of our portfolio? Here I have created a spreadsheet to illustrate. Say you start from 20 stocks, each with $500 investment. Total investment amount is $10,000. The column returns show the annualized return over the next 5, 10, 15 years and so on. I'm using a very conservative estimate here, assuming 6 of your picks are losing money, ranging from -8% to -0.5%. Bear in mind that this is an annualized figure, so if you lose 8% over 20 years, you actually end up losing more than 80%. So this is to account for stocks such as Tile Educations. The other companies I'm assuming they are making money. The highest one is 20.5%, so 20.5% compounding rate is definitely high, but this is definitely possible. Just take a look at the table below for list of stocks that are performing a return of more than 20% over 30 years period. Overall, if we take a simple average of these returns, I'm only assuming 6.3%, which is less than S&P 500 long-term return. Now let's see what happens to this investment after a period of time. Note that I assume there is no rebalancing among the stocks. If it underperforms, then its allocations will continue to shrink. Those that are doing well will have its allocations increase over time. So you can see that this 10K portfolio will grow to 24K after 10 years, 90K after 20 years, and 420K after 30 years. You see the overall annualized return are also larger because the portfolio will tilt towards successful companies over time. So the key takeaway from this illustration is that for long-term stock investing, a coffee can strategy that focuses on buying right and just sit on it is a powerful strategy, focusing on the winner companies instead of those incompetent ones. I will end this video with a quote from Peter Lynch: selling your winners and holding your losers is like cutting the flowers and watering the weeds. So keep the flowers instead. Invest more into those companies, and over a long period of time, you will see the magic of compounding. Alright, that's all I have for this week. See you in the next one. Cheers!